Welcome to our seminar on 2018 tax planning strategies. My name is Michael Solomon. I'll be going through a couple slides here with you. Those slides are going to overview some tax bracket changes, some changes in alternative minimum tax, how the deductions have changed, and then we're going to go into some planning strategies and decide if those strategies apply to you and then how you can best utilize those strategies. So what we're going to look at very quickly here is the two tax brackets, single and married filing jointly. And primarily this is just to show you the small changes in those tax brackets. What you're going to see here in the single tax bracket slide, and this is marginal tax bracket, that there is a slight decrease in marginal rate. Obviously the 15% rate's going down to 12, 25, 22, 28 to 24, 33 to 32. The 35% rate's not going to change. And then the top tax bracket, the 39.6%, is going to go down to 37%. But you're also going to see a slight increase in the amount within each marginal tax bracket of income allowable. And we're going to see the same thing again in the married filing jointly. And again, there's some small changes in here, but just giving a brief overview that there's about a 3% decrease on the marginal tax rate and then a minor increase in the taxable income allowed in each tax bracket. The bigger change here is going to be alternative minimum tax threshold and phase out, where it used to start in 2017 rather than previously. The single status threshold used to be $120,700. Married filing jointly was $160,900. Well, now it has been increased to $500,000 for unmarried, which would be single, and married filing jointly would be $1 million. And just to state here, alternative minimum tax actually has not changed really since its implementation. So this is a bit overdue for this change to come around. Now, if those changes weren't big enough, when we move on to standard deductions, we're going to see some very large changes. Where it used to be a standard deduction for single and married, $6,350 for single, $12,700 for married filing jointly, those standard deductions floor rather would be moved to $12,000 and $24,000 respectively. But what you're not getting is the exemptions, whereas before you were getting $4,050 per person. You are now not receiving any benefit for an individual. So now I'm sure you're thinking, well, I understand the standard deductions. Well, now what's happened to my itemized deductions? I've itemized in years past. How is that going to change for me going forward? And there are some changes, and they're pretty significant. The first one that's going to affect a lot of people is going to be your tax payments, and that would be your estate tax paid, your property tax, personal property tax, or sales tax, is now being limited to $10,000, and that includes all of those combined. Whereas before there was no real limit there. Mortgage interest now, there's going to be a small change where you could only deduct mortgage interest on $1 million of mortgage property. Now that's being moved down to $750,000 of mortgage property. Charitable contributions, obviously there's not going to be any change there. And then miscellaneous deductions, where it used to be a 2% floor based off of your adjusted gross income, you are now not going to be allowed to deduct any miscellaneous deductions. And there is a slight change for medical deductions, where the floor used to be 10% of your adjusted gross income. There's now a 7.5%. So what does that really mean? So what that really means is more people are going to be using the standard deduction than the itemized deduction, just because the threshold is so high. But it also means that for some people, especially high wage individuals, in the medium income area, have a lot of planning strategies that they can implement. One of which is IRA and 401k planning, which is, the first thing you have to ask yourself is, am I in a higher tax bracket now than I'm going to be later? So if you are indeed in a higher tax bracket now than what you're anticipating being in later, and you have to keep in mind that this tax bill is only really in effect until 2025, and then Congress has the option of repealing it or making it permanent. So taking all of that into consideration, if you are in a higher tax bracket now than you are going to be later on, then now is the time to start putting money into those IRA and 401ks, because you're reducing your taxable income. But we just want to make sure that you know, if it's close either way, obviously you can take the deduction now, and that's lowering your risk maybe. But you just need to make sure that you're using this strategy wisely and not just taking the deduction to decrease your current tax. On the other hand, if you are in a lower tax bracket now than you will be later, now is the time maybe to start looking at Roth IRAs and contributing to a Roth IRA. I mean, these are great strategies, or great strategies to take advantage of these accounts to have tax-free earnings and principal later on. Now, obviously, you are paying the tax now, which is why you have to make sure that you're in a lower tax bracket now than you would be later. These accounts also have some estate planning aspects to them, which is the inheritor of these accounts does not have to pay tax on, again, that principal or earnings. So then for older individuals that are 59 and a half or 70 and a half, one of the things to start looking at is possibly doing Roth conversions. Now, doing a Roth conversion is basically taking your IRA or 401k, if you're in a lower tax bracket now than later, and putting money into that Roth. So basically taking the tax hit now in a tactical way, and then reducing your overall tax later on. Now, one thing, if you are 70 and a half or older, that you can do is directly taking money from your IRA and putting it into your charity, or donating it to your charity rather. So there's a couple interesting features that have now come about, one of which, and I'm sure many custodians are going to start doing this, but Charles Schwab has started allowing a check writing ability from these IRA accounts. Really what that allows you to do, where before we would have to prepare a letter and send that into Schwab, and Schwab would send these amounts out, so it wasn't really beneficial from a time aspect to donate to some of these smaller charities, where now you can directly write a check to your charities, whether it be $20 or $200 or at whatever incremental period that you would like to. The benefit of this is you're taking a deduction above the line, which really means this is affecting your adjusted gross income, which for a lot of people will affect your Medicare tax. Especially at that age, if you have started, or at 7.5, hopefully you started your Social Security benefits. This also maximizes those charitable deductions. So really, dollar for dollar is what you're saving, because instead of taking your required minimum distribution, which is what we're trying to offset here, you're getting to take that money again above the line, and then maximizing that standard deduction that you have. Now, one thing that a lot of people can look at, whether you're in the retirement age or just a normal wage earning age, is that you can double your deductions. And one of the strategies really is for individuals that are really close to itemizing. So one year they might itemize, the other year they're not. But we're talking $1,000, $2,000 kind of around there. And what you would do in this circumstance is you would want to maximize your taxes being paid, and you would also want to maximize your charity. I know charity is something that we're harping on in this seminar, but let's say you were making $10,000 a year in charitable contributions, and you were able to itemize at $25,000 married filing jointly. Well, if you remove that $10,000, then you're getting $9,000 of benefit, being that you're on a standard deduction. And then the next year, or the current year, depending upon how you set it up, you double your charitable contributions. And one way that you can do that, if you're not comfortable in contributing all at one time, is to do a donor-advised fund. And again, many custodians have these now. What that really is contributing to one of these investment accounts. And that investment account can be distributed at any point, but you get the deduction currently. The one caveat of these accounts is you cannot go from your IRA or from a qualified retirement account into one of these donor-advised funds. It has to be from a non-qualified taxable account or from your bank account. So one thing as well that we want to make sure that we're doing in all of these strategies is that we're looking at the big picture. As a tax guy, tax planning to me is extremely important. But now that the standard deduction is so high, we want to make sure that by making these tax-saving decisions that we're not affecting a larger financial planning decision. A good example of that is mortgage interest right now. Where before, with the standard deduction being so low, mortgage interest used to be a valuable financial planning tool and a tax planning strategy, in that it was saving you some dollars on your taxes. Therefore, the interest rate may have been cut by a certain percentage. So it was better to have that mortgage interest in a financial planning sense and in a tax planning sense. Well, now with the standard deduction being so high, that mortgage interest may not be as valuable. So given the option to pay off the mortgage interest, pay off the mortgage, makes it much more valuable to do that rather than to keep it, as the mortgage interest itself has become less valuable. But if you guys have any questions, please feel free to contact us here at Townsend Asset Management. My email address is Michael, spelled Michael, at assetmgr.com. I appreciate your time, and thank you for listening to our seminar.